Now that you have a solid understanding of the differences between reinforcement learning and other types of machine learning, we will look at the key features of reinforcement learning which can improve the performance of trading strategies developed with deep learning techniques. By the end of this session, you will understand the differences between deep learning and deep reinforcement learning and have explored each component of a deep reinforcement learning strategy. You will also understand how DRL can improve your strategy's efficiency and performance. To begin, let's talk about deep reinforcement learning from a financial markets trading perspective. DRL puts an agent into an entirely new environment and allows it to get used to taking the best decisions based on specific circumstances of each state it encounters. The agent does not have any previous experience or prior knowledge of what consequences to expect from its interaction with the surrounding objects. Its main goal is to start collecting information about the environment which can, later on, help it make an informed decision. The agent does this by testing how the state spaces it encounters react to its decisions. The agent's human developer sets rewards for each positive choice and penalties for each negative choice to help the agent build a logical framework with which to differentiate what is considered a good and a bad decision. The more frequently the agent interacts with the environment, the more it learns and the better it becomes at making decisions that will maximize its reward. How is this different from machine or deep learning models where a human developer is involved in the process? The main difference is that deep reinforcement learning agents are given a high degree of freedom. Once they are given what is considered a positive or negative outcome, they tend to build on that logic and further develop it based on their individual experience over time. They become to some degree independent operators that base their decisions on self-gathered feedback. This allows DRL agents to extend beyond the limits of the developer's knowledge and solve more complex problems. In this section, we will look at the key components of a DRL trading strategy. Most studies conducted on the DRL framework are related to gameplay. There is not so much work focused on the application of deep reinforcement learning to trading. Although the adoption is in its early stage, there are some studies that point out the superiority of DRL algorithms when compared to existing automated trading mechanisms in terms of performance. This means deep reinforcement learning can help in handling some of the most complex issues that traders face in financial markets. Strategies require error-free handling of large volumes of nearly continuous data. Agents' actions may result in long-term consequences that other machine learning methods are unable to measure. Agents' actions also have short-term impacts on the current market conditions, which makes the trading environment highly unpredictable. Now let's find out how DRL's application to trading can work in practice. In the process of applying DRL on financial markets, researchers have narrowed down the architecture of trading algorithms to the following main factors: agent, environment, state, and reward. The agent is the trader. It has access to a brokerage trading account, periodically checks the current market situation, and makes trading decisions. The usual methodology when trading is as follows. The agent makes a decision, places an order, and then waits for the market's reaction. The order is executed or isn't executed. Based on the environment's feedback, the agent then takes another action, either submits a new order, changes the terms of the existing one, or remains passive. The agent analyzes the response of the environment and decides on its further actions based on the specifications of the current state. The agent does not have control over the environment or over the actions of other agents. All it can do is react to them. This is the market or markets for assets that will be traded. The market is full of other agents as well, both human and computer-driven. These agents demand or supply liquidity. Public liquidity is shown in the order book. private liquidity is hidden in dark pools and order execution strategies. The interaction between all agents within this complex environment is what makes creating a trading algorithm so challenging. The state of the environment, or the market, usually is unclear to the agent unless it has some sort of insider information or technological advantage over other market participants. It is not aware of the number of other agents, their actions, their positions, or order specifications. The reward function is crucial for the success of the deep reinforcement learning algorithm. If the reward function is naively driven by absolute maximization of potential profits, the algorithm will start placing highly risky bets, underestimating the potential losses in the name of reaching its ultimate goal. In reality, traders strive for an optimal Sharpe ratio, which has proven to be the most efficient reward goal for DRL algorithms. Next, we are going to look at how you can improve the efficiency and performance of your trading strategy with DRL. The application of deep reinforcement learning for trading still remains largely unexplored. However, the promise that this learning strategy has shown in other fields has attracted researchers' interest and focused efforts on the exploration of DRL for trading. For now, the odds that quantitative trading can be disrupted by DRL look good. Some of DRL's advantages include being a good match for a rapidly changing market environment, it having a high potential power and efficiency, and most importantly, that it builds on other machine learning techniques that have proved successful in multiple markets. Financial markets are dynamic structures. Today we have plenty of different types of orders, quantitative trading strategies, new asset classes, technologically enhanced market participants, and many other market variables that were not present a short while ago. Also, the markets of today are very turbulent with increased volatility, lower liquidity levels, and periodic flash crashes. The presence of these factors influences the way we trade, and so results in the formation of short-lived or unique patterns. These patterns are usually very hard to identify in historical data and can also turn out to be irrelevant for the accurate prediction of future market movements. If similar patterns are found in historical data, there is no guarantee that the next time they occur, the outcome will be similar. All this has affected even the most sophisticated fund in the world, Renaissance Technologies. The hedge fund has reduced the use of pattern-based strategies for futures trading in its Renaissance Institutional Diversified Alpha, or RITA, fund by more than 60%. However, RITA still remains way ahead of the competition after the fund gained 3.23% in returns in 2018 when compared to the industry's average of minus 4.75%. When it comes to other trading firms, the truth is that a major part of hedge funds are giving up on trend-following strategies after they've struggled to replicate past returns. In order for an automated strategy to be successful, it has to be flexible and capable of adjusting itself to the present situation and not rely solely on past information, just like their human colleagues do. For now, deep reinforcement learning is the closest thing we have to resemble the way we learn. Just like us, DRL agents learn on the go and by doing. This means that they are getting better at taking real-time decisions based on the specific characteristics of the moment. At its core, learning is an interactive process that requires feedback from both sides. And that is why it's reasonable to expect that deep reinforcement learning agents will become better at navigating financial markets due to their ability to adapt to changing environments and learn from the immediate result of their actions. Financial markets can be considered as a high-density environment because of all the variables affecting the result of a trading decision. For example, even the most basic orders will require the computer to make a set of feasible decisions like price, size, order time, order type, etc. All these factors require the algorithm to make a set of interconnected decisions, such as at what price to buy or sell, and what quantity, whether it should be a single or multiple order at different or the same prices. Should it trade at one or multiple venues? Should it do it one after the another or simultaneously? According to the estimations in JP Morgan team's idiosyncrasies and challenges of data-driven learning in electronic trading study, a medium frequency electronic trading algorithm will make 3,600 decisions per hour. This is due to the fact that each action is a consequence of a collection of child orders with different characteristics, price, order type, size, etc. What this means also is that financial markets are way too complex for straightforward algorithms, as their action space is continuously expanding with all of the possible combinations of moves and market characteristics changing all of the time. Existing algorithmic models are designed with two main components: strategy and implementation. The strategy is usually designed by the trader, while the implementation is handled by the machine. In reality, there are autonomous trading mechanisms, although most of them still need some human guidance. Although this may seem like a promising human-machine symbiosis, at some point, a crucial element in the whole system often tends to break down and leaves a lot to be desired in terms of trading results. For example, one of the main challenges is picking appropriate, unbiased, and representative financial data. The inability to do so is often the trader's fault rather than purely a technical limitation. Although the data quality problem is a well-known weakness in the design of efficient trading algorithms, it still remains an issue, and its solution is often quite poorly implemented. However, with the major improvements that deep reinforcement learnings bring, we are getting closer to facing the next level of autonomous trading system, one where the machine is in charge of both the strategic and the implementation parts. Deep reinforcement learning mechanisms, as shown in other fields, can help us construct portfolio management systems with basic cognitive skills that can ensure better navigation in the complex stochastic environments of financial markets. Although way more flexible and powerful, a deep reinforcement learning agent still requires millions of test scenarios to become proficient at what it does. Think of AlphaGo, for example. Also, the fact that these types of agents are closer to autonomy, they still require an operator to assign a reward to their actions, either positive or negative. From a purely technological point of view, the reward part is quite tricky, as it has the potential to become the make it or break it element in the whole system. For example, if you reward a robotic vacuum cleaner with the absolute goal of cleaning your living room, you may end up surprised to find that it has swept all the dust and dirt into your kitchen. What this means is that computers are still far from general intelligence and will continue to require human guidance, even if it is in a more limited form. For how long remains to be seen. But as things stand, we are closer to a fully autonomous trading system than we have ever been before.